we're going to be putting $100,000 worth of work, and we think this property is going to be worth $1 million. We try to do our best in avoiding any type of fraud.
So I know we're not going exactly down these questions that we said we were going to go down to. Hey, how are you using AI to help you in running your business? Because that has been something on my mind is underwriting. And now I don't really have to anymore. And when I'm writing PPMs or OMs, I don't really have to do that anymore. To ask advice from an attorney, I don't really have to do that anymore. So AI is affecting a lot of things that I do in my business, but how is AI affecting your business and what AI tools are you using?
I gotta tell you, I'm an attorney myself. I don't practice, but I'm an attorney myself, and I gotta tell you, some of the things that I see AI or Chat GPT or Gemini kind of pumping out when it comes down to law is the complete opposite of what the law really is. I would recommend that you still, and that's not always the case, but I would always recommend that you still try to consult with an attorney. And again, depending on what you're consulting on, right? But the answer to your question as far as what we at Relend are doing to kind of implement Chat GPT is a number of things. One thing is that we try to do our best in avoiding any type of fraud. And what we've learned is, with ChatGPT and other AI tools, there's a lot of borrowers that are tampering documents, right? They're tampering purchase contracts, photo IDs, they're tampering appraisals and all that good stuff. So we've implemented some tools to be able to avoid and be able to kind of pinpoint and give us an alert on what has been tampered and exactly where it's tampered, right? You would be surprised as to how many people that have actually submitted applications to us have been denied outright because we already know that the documents that they've provided have been tampered with. Most of the time, we won't even go back to it. We'll just kind of blacklist them and never work with them ever again, or even the broker. But, we've caught a lot of people by doing that. In addition to that, look, we're implementing a broker portal. We are very relationship driven with our borrowers, our broker relationships, and so on. So being able to provide a broker portal that is essentially providing the brokers with a number of tools that they don't have today is critical. And, that's something that we're also implementing today.
Okay, fantastic. Well, I think that answered all my questions, so we can move forward now. What challenges do real estate investors face when trying to secure, private financing? And how does WeLend address those challenges? Like, what kind of differentiates you a little bit in being, relationship?
So look, I mean, today, 63% of our loans are with repeat borrowers. Almost 90% of our loans are with experienced operators. So I feel that, the biggest challenge that investors have today is in the beginning stages, right? Is their lack of experience. With lack of experience, if you haven't invested in a syndication with, say, Jacqueline, right? Or if you haven't invested into other deals as a passive investor, well, you're probably going to have a challenge in really identifying what the values of the property are as is and after repair. And I feel that that's one of the biggest challenges that many inexperienced operators are kind of going through today is, they're coming in and saying, Ruben, we're buying this property for $500,000. We're going to be putting $100,000 worth of work, and we think this property is going to be worth $1 million. Well, I look at the property, I look at the asset, I look at the appraisal, and I say, look, there's no way in hell you're going to finish this project at $100,000. You're looking at least $300,000 in renovations here, right? In addition to that, you think the property is worth $1 million. Well, the comps don't demonstrate that. The comps show a value of about $900,000. So if you're $800,000 into the project, not including closing costs, not including carrying costs, not including costs at sale, you're losing money, right? So we feel that the biggest challenge that inexperienced operators have is that evaluation of the resale along with the renovation. So one of the things that we do to kind of combat that is to give them the guidance that they need to be able to execute on those properties, right? We tell them, hey, you need to go back. These are the numbers that you need to be. You can't be given an offer of 500,000. You need to be at 350,000 or what have you. So we give them that guidance to be able to execute the project, but most importantly, execute in profitability.
Sure. So, do you ever recommend? Because I often do this to people that come to me and say, hey, how can I get in? I want to flip a house or I want to do this. And they go, but I have no experience. So, I often tell them, well, maybe you should partner up with somebody that does on this first deal to get that first deal under your belt. And now you at least have one house that you have under your belt and that builds your credibility. What kind of other advice would you give on the experience front with never having done a renovation before?
It's a very good question. We've had borrowers that have partnered with each other in the past, and some of them executed well. I mean, their relationship has grown, and they've really, even not only have they executed on those one or two deals, but they've actually partnered up to execute on future deals as well. Some really blew out, right? Meaning that it didn't go well. That one experienced operator may have bit off a lot more than they can chew, and they started defaulting on other loans with other lenders. And that kind of drags them, the investors, the passive kind of new investors, novice investors, into the mud with all the other deals that the experienced investor has gone down with, right? So we're trying to shy away from partnering or connecting investors because of that, because of all the baggage that might come along with it. So one thing that we are recommending investors is, new investors, is just put more money down. Right? Really underwrite your deals a little bit more with, I would say, kind of diligence involved, right? Here are some books that you should read. Here are some tools that you should use. Here are some channels that you should really kind of listen into and tune in, because these are the people that really done deals, hundreds, if not thousands of deals, that give you all the pitfalls that you need to be aware of. Well, the challenge that comes with that is a whole separate thing, because then, what happens is that they see all the pitfalls, they hear about all the pitfalls, and they're like, holy shoot. Exactly. They're like, we're going to go back to being a doctor. We're going to go back to being an attorney or what have you. Let us stay doing what we've done before. Well, everyone has their own luck. Everyone has their own kind of, as we say in our culture, mazal, right? So I would say that, be cautious, cross all your T's, dot all your I's, and sometimes you just have to take risks.
Good advice. So I will start telling them to educate themselves and save more money if they want to do their first deal versus saying that, you only have to bring, 20% down or 10% down or whatever the amount is. So, okay, part of what we do as affordable housing in our local market is we buy private money and then we do what's called cash out refi. And people go, what the heck does that mean? So I'm going to ask you the question because I already kind of know the answer, but I would love to hear your response. How can investors leverage financing to grow their portfolios in a competitive real estate market?
So look, the beautiful thing about, being a real estate owner, developer, operator is the ability to be able to refinance your properties every 3 to 5 or 7 years, right? The reason to that is because, well, one, and first thing is, every time you refinance your property and you cash out, while it may not be the same, and it never will be the same as you would had you sold the property, but if you take, the closing costs involved with us resale the property, along with the taxes, the capital gains, whether it's short or long, involved with it, you're probably netting the same amount as had you actually refinanced and cashed out. And the reason why I say that is because in a refinance, there's not as nearly amount of closing costs as there would be in a resale, right? But most importantly, in a refinance, and especially when you're cashing out, that cash out component is tax free. And that is critical, right? I mean, that is huge, because at the end of the day, you're saving yourself that extra 15 or 30% in capital gains had you sold the property. But also, it is something that you can actually use to offset your taxes, because the interest that you're paying essentially offsets your taxes. But most importantly, the depreciation that you're able to use through the properties that you're buying is a huge, huge game changer. So, I say huge so many times. I've been listening to Donald Trump for a little too long, but nevertheless, it does make a very big difference. Not huge, but big difference.
Yes. I often start by, telling people what we do. And I give them an example of a 6 unit that we purchased. And, we bought it hard money. We cashed out refi 8 months later and we pulled $125,000 out of it. And here's the best part. And they're like, oh, but isn't your debt going to go up? Absolutely. Your debt's going to go up. I'm not afraid of good debt. I'm not afraid of good debt versus bad debt. We don't want bad debt. So my mortgage went up $500, but I'm still cash flowing $3,000 a month on this property. So I'll take the debt all day.
I totally agree with you. I mean, look, I think there's a misconception of debt. There's a misconception of using or levering up your properties. Look, obviously, if you look at, the history, any over levered investor, real estate operator, developer, they did go belly up, but that's because they were over leveraged, right? A healthy amount of leverage is critical to the operation of your business. And I think having a healthy amount of leverage is something that you absolutely need to kind of incorporate into your real estate business if you want to be successful in it.
I remember Robert Kiyosaki, listening to his podcast. He says, what's the one thing that you would do differently? He was like, get more debt.
He is huge on that, by the way. But he is smart with the way he operates. He is that one person that always voices that one thing. Healthy debt will always take you far. Obviously, unhealthy debt will really drag you down.
All right, cool. So final topic is, I think we talked a little bit about what our turning point is going to be in our business, right? We hope to double our portfolio. And then from there, start to do things that are truly passive. So let's face it, people think, oh, the real estate game. Well, we are active investors in the units that we own in our local market. That's a lot of work, right? And even if we have people and processes in place, it's still a lot of work. So our plan is to we're having a very healthy amount of cash flow coming in from these rentals. We have right people in place that reduce our workload. And now we want to pivot a little bit and say, what investments can we make that are truly passive? Not 1 minute of my time more will be spent on real estate investments. So talk to me a little bit about your suggestions for somebody like me to do with like all this money that I'm going to be having coming in the next, 6 to 12 months.
Well, first thing I would tell you, Jacqueline, as soon as you have that money come in, you got to call me. We'll figure it out. There's this running joke that we have with our friends. If you have money, call me. All right. Otherwise, don't call me. No, but I'm joking. Look, at the end of the day, there's a lot of things that you can invest into, right? Whether it's a syndication through groups like yours that really know what they're doing, they're experienced operators. There's a number of benefits that come involved with that, right? But there's also debt funds like ours. We do manage a 506c Reg D. It is an exemption through the SEC. Most of our the funds that we actually essentially deploy into the debt that we have today is through our friends and family. It's raised through people that we know on a personal basis that we see day in, day out, which means that, every dollar we deploy, it's as though it's our own money. Now, we're significantly invested into our fund as well. And the main reason why I think, there's a number of reasons, but I think some of the common reasons why a lot of our investors like to invest into debt funds is because of the liquidity of the funds, right? The investment into a debt fund is only locked up for a period of only about 12 months. It's not a 3 to 5 year lockup period. It's a short period, right? So 12 months. And the reason why is because, we as a debt fund, we're in the business of being liquid. And if we're not liquid, we're not, in business. Additionally, the cash flows are instant. In some syndications, depending on what you're buying, right, there are no cash flows, or there's minimal amount of cash flow, enough just to maybe service the debt, if that. So, the cash flows with our fund are instant. As soon as our investors, our borrowers are paying us, we are paying our limited partners, our investors. Also, there's predictability and consistency. You know exactly what you're earning from day one because of the fact that we're charging a fixed rate on a fixed basis and a fixed loan. So you'll know exactly what we're earning and so on. Now, also, it's diversification. When our investors invest, they invest into a number of different loans versus just one asset. It's a number of different assets, a number of different borrowers, and a number of different geos. So diversification is really what they're receiving. And obviously, the most important thing is it's passive. We're not dealing with the tenants. We're not dealing with the construction. The investors, the borrowers are, right? So you as an investor are really receiving that passive mail check money, as Kiyosaki always says, that is deposited directly into your account, and it's done so instantly, probably within 45 days of your investment.
So if I had $100,000 right now and I gave it to you, what's the rate looking like today? So it's February 6th, 2025.
Yep. The return of investment right now, depending on your investment amount, because we have Class A, B, and C shares, depending on your investment amount, it's anywhere between, I would say, about 10 to 14% on an annualized basis. So that's, assuming it's a 14% return, depending on your class of shares, you're receiving a little over 1% on a monthly basis.
Well, I think we're about out of time. We said we were going to go for like 25 minutes. We're up to 30. So Ruben, if folks want to talk to you a little bit more about WeLend and your lending company, how do they reach you? How can they find you?
So we're on all major social media platforms. Our handle is WeLend LLC. You could visit us on our website, www.welendllc.com. And you could also give me directly a call at 917-815-1222. And if I don't answer, shoot me a text and I respond fairly quickly.
Well, Ruben, it's been a pleasure having you on our podcast today. And thanks for the great insights that you have. And we'll be in contact too to kind of talk about how we can work together.
Jacqueline and Melvin, thank you so much for taking time out of your busy day to listen to this episode of Get Diversified. Please make sure to subscribe to our podcast so you don't miss out on future episodes. Finally, stop by our website and follow us on social media. Ciao for now. Make it a great day, and we'll see you next time. And remember, get diversified.